The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. In this episode, Darren is joined by Kim Moody of Moody's Private Client, who says Canada is mired in bad tax planning, and it's all based on ideology.
Hi, everyone. I'm Darren Coleman, Senior Portfolio Manager with Raymond James in Toronto. Welcome back to another edition of Two-Way Traffic, the podcast. I'm delighted to be joined today by Kim Moody of Moody's Tax and Moody's Private Client. You're also a law firm based in Calgary, Alberta, and you're probably one of Canada's best-known tax and estate planning advisors. You're in the press quite a bit. You work a lot with owner-managers, professional athletes, executives, entertainers, and people both in Canada and the United States. So thank you for joining me in our conversation today, Kim.
Oh, my pleasure, Darren. Thanks.
Now, for listeners, if you heard our last conversation with Trevor Perry, who I know is a good friend of yours, and you guys apparently have some ongoing battle about pinstripes versus checks or something else that is extremely important for the rest of us to follow, and may the battle continue. I wear solids because, you know, it's slimming and I'm trying to have a hot girl summer. So these are the things that I do. But you wrote an article, and then Kevin and Trevor and I talked about this, and it was about some of the issues that we might be seeing in terms of taxation of the principal residents in Canada. And I've been saying for years to clients and anyone that will listen that I think because governments have spent so much money that we're going to see tremendous innovation in taxation. And the most recent one being about housing is just one illustration of where this might go. And then you and I are going to dig into a couple of others. But do you maybe just want to set the table a bit for the article that you wrote in the Financial Post where you talked a bit about where this is coming from and why I think Canadians might be on alert for what might be coming to tax the equity in their homes?
Sure. So the point of the piece was mainly just to put Canadians on notice that you had the Prime Minister and the Finance Minister, sitting down with what I call pretty radical. They call themselves a think tank. I hesitate to use that phrase because I don't consider them a think tank. I consider them an ideological bastion of radical thought. But that issue aside, they call themselves a think tank, and this particular one, led by Paul Kershaw of Generation Squeeze, has stuff on their website that pretty much attacks the older Canadians to basically saying that they've got rich, and this is directly on their website. They've gotten rich by going to sleep and watching TV, and so the whole point is how
to make friends, win friends, and influence people with that line of thinking, right?
Unbelievable. Whoever approved that. I mean, it's just so offensive. But that issue aside, the whole connotation of the messaging is that, hey, these people are rich. We've got these poor young Canadians who are not, and they can't afford houses because you're rich. And
someone should do something about it, right? That's the trick. Someone should do something.
Someone should do something about it, and their solution is to introduce a so-called home equity tax on any equity of $1 million or more, and they call it a modest surtax of 1% per year. So it's like another effectively property tax.
A modest proposal. Where have I heard this before?
Yes.
Yeah.
Nice language by the radical left. It's just so nonsensical and so offensive on a whole bunch of different levels. Like you think about, I can think about grandma and grandpa. They've got equity in their homes, but they don't have a lot of cash. They've been working hard their entire lives to pay off their houses. And yes, they want to transfer it down to their kids at some point, but right now they're living it. And they're making ends meet by living off their pensions that they worked hard. And you're expecting them to shell out more money for that. And I find that offensive. But if you keep on reading, their proposal, like they don't talk about what the money will be used for. Of course,
or who's going to get it, but someone needs to do something.
Yeah, these organizations never talk about that because tax is always the savior. I like Winston Churchill's line, which I think I used in that article. You can't tax your way to prosperity. And there's something like that. I think that was Winston Churchill. It might have been somebody else. But anyhow, to make a long story short, they also go on to say that that because of this surtax, this charge, that the housing market will stabilize and maybe even come down a bit so as to make the properties more affordable. And I'm thinking, where did you take economics? Because
one of the things they talked about was they want housing values to stabilize so incomes can catch up. And I'm like, I'm not sure how one accomplishes that in a free market society without it remaining a free market society.
Well, exactly. I mean, basic supply and demand economics, right? Which the radical left are always willing to throw out basic concepts of economics. And
the Soviets tried that, right? With, we're going to make the price of bread this. There isn't any bread, but the price is low.
Right.
There isn't any, but the price is low.
And it's just stuff like that, to go back to the original premise of why I wrote the article is, number one, just to let Canadians know that our leaders are entertaining stuff like this. It doesn't mean that they're going to implement it, but they're actually entertaining radical organizations like this.
Yeah.
And if you watch the interview with the Prime Minister, there's a lot of offensive stuff in there. And then secondly, just to put Canadians on notice that this is just the beginning. If this regime continues with out of control spending, no adherence to basic economics, and then we can expect a whole bevy of other taxes. And this is just the beginning.
Well, and indeed, they've already done some of this, right? So, this idea about we're going to tax home equity either through some kind of annual surtax on equity over a certain amount, or we're going to put a capital gain on principal residences. And I would argue that for years now, Canadians have had to report the sale of their principal residence on their tax return, which is a non-taxable event, yet you now have to tell them. And if you don't, there's a penalty. I think that might just be to put the bureaucracy in place for what might be coming. But we've also seen, and I know you've also written about this, the latest change to the capital gains inclusion rate. And the way in which they've justified some of that is also very curious. Do you want to talk, like, for example, they talked about only 0.13% of Canadians are affected by this change. Is that number accurate in any way?
That number is so manipulative. So the way they, when I saw that in the budget documents, when I read it on April 16th, I thought, holy geez, how are they getting this number? Because that's just not right. And so then they go on to explain how they get it. And it's like, oh, really? That's your methodology? And the methodology is this simple. They picked, I think it was 2022, if I recall off the top of my head. And they said,
pandemic's still rolling, not quite over yet, right?
Yeah. And so they said, okay, these are the reported capital gains, and these are the number of people who had over 250,000. And because of such a small number compared to the entire population of taxpayers, that's 0.13%. So they extrapolated from 1 year.
1 year, which, by the way, it was a negative year in stock markets globally. Oh, so they happened to pick that year.
I didn't even think of that, actually. Yeah. Good point. But here's part of the problem with that. Capital gains are realized, as you know, as a portfolio advisor, they're pretty lumpy. Yes. And especially when you're dealing with monumental type assets, like a lot of Canadians have cottage properties. I think the last numbers I saw, there's 3 or 4 million. I can't remember the exact number, but it's a lot of people that have cottage properties and then rental properties to try to provide for their retirement. Mm-hmm. So the issue is that those capital gains will be realized either upon death, upon an eventual monetization, or a gift to their children during lifetime. And so,
many of those returns were just inflation, by the way, which people should know. If you bought it in 1979 and you finally sold it in 2025, well, most of that is inflation. Right. And you're paying tax on all that inflation.
Yeah, which there's a big debate on that, that goes back decades and as to whether or not you should even tax capital gains given that it's inflationary. And I think there's a good argument to be had about that. But having said that, did they even think about that people are going to be affected by this during their lifetime? Jack Mintz wrote an article on this very point, and he conservatively estimated that 1.25 million Canadians will be eventually affected by this proposal. And he admittedly said in his article, and when I talked to him privately on this, that number is likely very low. And so when you think about that, 1.25 million, even if that's very low, the number of taxpayers in Canada is about 29 million taxpayers today. Our population is a lot higher, but that doesn't mean they're taxpayers. So is that a material number? Yeah, that's a material number.
Well, and for most Canadians, they're not going to be having this touch them until there's a deemed disposition at death, right? So mom or dad or whatever pass away, the cottage, the rental property, whatever it is sold, and a generation's worth of equity is all going to be realized at once, and that's when that much higher capital gain comes in. So many people walk around and don't think this applies to them. They'll discover at that one moment in time that, it actually applies to you quite a bit.
Here's another one, and Jack hinted about this, but he didn't do any math on it. I rang the alarm bell pretty quickly on this. So, and you probably deal with a lot of pensioners, people that, and so what are they investing? What are pension funds in Canada typically investing in? Well,
companies,
you tell
real
me.
estate.
Yeah. But are they investing in, for example, public companies that pay dividends?
Yep.
For sure, right? Because it adds to their portfolio. What happens if those companies have capital gains now? Well, they're going to pay higher tax, which reduces the amount available to pay as a dividend.
Right. Now, it's all friction to the return pattern, right? Yeah.
Exactly. So are we going to see over time a statistically significant amount that is reduced on dividends to the extent that public company has capital gains, which many of them do?
Mm-hmm. The
answer is yes. Will we? And which ultimately means that pension funds will come down. Now, it'll take a while for that whole cycle.
But now, all Canadians will feel that, right? Whether it's in their pensions, their RSPs, whatever it is.
So is it 0.13%? Is it 1.25 million? Or is it something like 28 million?
Right.
I think it's closer to the bigger number. And so in any event, I could go on and on, but I can't stand the deception.
Well, one of the things you also just mentioned in the conversation was about tax policy. And one of the other elements to the capital gains tax was that individuals were given an exclusion of $250,000. The higher rate doesn't apply. Little complicated how it all blends in year one, but that's another conversation. That might be a little inside baseball for this. But the other reality is that for anyone who's saving inside their corporation, which in many cases are doctors or your next door neighbor who owns a plumbing business or something, they do not get that additional amount. They're paying a higher rate of tax on $1.
Yeah.
And from a tax policy perspective, there's this idea of integration, which maybe you could talk about. And does that change because it's different from corporate versus an asset held personally? Does that further enable this concept of integration, or does it make it not work very well anymore?
What do you think the answer is?
Oh, but I'm not the CPA, my friend. So I might know the answer, but you have to tell them.
Well, you've kind of teed this one up on a.
I told you I'm going to put the Titleist on the tee so you can hit it.
I like it, even though I'm a shitty golfer. So.
I don't have a handicap. I have a disability. I can part right next to the clubhouse. These are my jokes.
The short answer is, of course, it throws integration out. And what is integration in a nutshell? Well, years and years ago, the tax policymakers for Canada wisely designed our tax system so that ultimately investors should be neutral as to which legal form do they place their investment dollars. So if you place your investment dollars individually, or place them through a partnership or a trust or through a corporation, and just focusing on a corporation in individuals is the easiest to think about.
Sure.
If I take $100 and invest it individually versus $100 I place it inside a company, well, if I make $10 of interest income on that $100, which would be a great year, but let's just say I do, the tax that I'm going to pay by theory should be exactly the same on that $10 of interest income if that interest income was earned through a corporation. Now, in a corporation, you're going to pay a combination of corporate tax, and then when you take out that after-tax return by way of a dividend, which is the only way you can take out after-tax corporate rates of return, by definition, from an accounting perspective, legally you can be a little more creative, but that personal tax and the dividend plus the corporate should equal the same tax had I earned it individually. That's integration.
Yes, the idea is if I have that dollar, whether I own it personally or the company, I could run through all the gymnastics, or you guys do.
Yeah.
But I should be agnostic, right? If I
Yes.
I should be like the same 38 cents or whatever it is at the end, whether it came one way or the other. The tax system was designed to make me neutral on that, right?
Exactly.
So I should wind up in the same place.
I like your word agnostic, because that's exactly what it is. You should be neutral from where you place your investment dollars in legal form.
And from time to time, it's not. I know from time to time it might be a little bit better to earn that. And it's usually pennies, right? It's not that dramatic usually one way or the other.
It's usually 1 to 3% on the most. Now, and right now, most provinces, because there's a provincial element here as well, yes. Most provinces are not in favor. In other words, it's not in your favor if you have a choice to invest investment dollars inside a corporation. Much better to invest personally. And so,
which by the way, surprises people. I think the average Canadian walks around, because of maybe some of the political rhetoric, thinking all these people are leaving this money in their corporations and cheating everybody.
That seems to be,
and they get all the loopholes and the write-offs that I'd like to know what most of them are, but they apparently exist. And I've only done this for 32 years. I know I look 26, but I don't know what they are, but I'd love to. Maybe you know what they are. You're like the bartender at Yuck Yucks now. You're not laughing at anything. Okay.
No, I'm not. No. Well, just to digress for a second, do you ever watch Seinfeld? Because I think you.
Of course.
Okay. Do you remember when Jerry's stereo doesn't work, and so Kramer comes up with a brilliant plan that he's gonna get his money back, and so he busts it all up, unbeknownst to Jerry, and sends it in the mail, buys the insurance, and tries to rely on the insurance, and Kramer comes back and tells him the plan, and he says, "You can't do that." And Kramer says, "Well, sure you can. It's a write-off." And this banter
everything's a write-off.
Yeah, banter goes on, and finally Jerry says to Kramer, "You don't even know what a write-off is." And Kramer says, "You're right, I don't." So,
I do remember that.
So I often use that because there's so much mythology in tax that it's like the Kramer and Jerry scenario. They get all these loopholes, or all Canada needs to do is go offshore and grab all that money because all these rich guys are not paying tax. Yeah, right. That is such garbage.
These are the same ones living behind their walls in their gated communities with their airplanes that I've never met.
Yes.
But apparently there's so many of them. Every street corner has them, I guess.
Yeah, apparently. And that's why we needed the capital gains inclusion rate increase. So is to
but this idea, yeah, so I would, it sounds as though, if I read this correctly, it was less about maybe great policy, because if it was really good policy, they'd somehow preserve integration, or that would have been a key element of this. But that sounds like that's not what they were after. There may have been some other political dynamic, right? Because if they had maintained that same threshold or tweaked it, they could have kept integration. Yeah. Like I think that if they'd allowed perhaps the individual business to have that same exclusion of 250,000 or whatever the math would suggest, they could have protected that concept somehow.
Yeah. I think really when they designed this, it was designed in a real hurry, and they found these nice statistics that moved into their narrative, the 0.13%, because corporations are viewed to be for the rich, and therefore we'll take care of the individuals on the first 250, but we won't worry about the corporations and trusts because they're viewed to be rich. So this was pure ideology and really bad tax policy. It's as simple as that. And then to compound it even worse, Darren, I'm sure you followed this, but they put this June 25th arbitrary deadline, which was roughly 10 weeks after the budget announcement, and they encourage Canadians to monetize and crystallize capital gains.
To drive the bill up a bit higher. Yeah. We had a few conversations with clients about should we do this or not do this? And I think otherwise they would have not touched the asset.
Yeah. Right? Well, what I found offensive about is in the budget documents, they budgeted $7 billion of extra tax revenue for monetizations and crystallizations. Like, how offensive is that?
Well, what's interesting to me on that topic is if they really wanted to be sure that was done, why did they make people go and actually create a transaction? They could have just filed an election on their tax return potentially and said, I'm willing to trigger this. I can't sell my cottage in time, but I'm willing to take the thing and I'll pay the tax some other way right now. There were other ways I think they could have accomplished that same feat without having people run around trying to get all these transactions done and maybe selling at the wrong time, or my accountant's and lawyer's going to charge me a fortune, or what if I can't get it done on time? I don't get to benefit from it. So there's been a lot of issues around implementation for sure.
Yeah, and there's history behind this, right? There's good precedent. February 22nd, 1994, when they eliminated the $100,000 capital gains deduction, they had this is going to show my geekness here, but they had a 110.619 election, right? The one-time election. And you could file it on your due date of your tax return, which is in some cases more than a year later.
Oh yeah, like full disclosure, this wasn't Darren's idea. I thought I'm sitting here. No, there was precedent for this idea for sure. Like they had it in the playbook, right?
Yeah, so they could have done it, but why didn't they? I think, and of course I don't have confirmation, I think that this was dreamed up at a very last minute entry into the budget documents. You can tell by some of the shitty language in the budget documents. And ultimately, at the end of the day, they just didn't have time to think this through.
So are you trying to tell me that this may have not been well thought out, especially on the heels of how well they handled things like the Bear Trust reporting? Like that was so well done. I can't imagine they would have not done it well later. You got to be kidding me.
The whole thing, the introduction of it, the premise of it, and the messaging behind it, very poorly done. Frankly, it's embarrassing.
So we'll talk about the U.S. in a sec, but from a Canadian taxpayer's perspective, dealing with all these things going on, what are a couple things you recommend people do to try and they can't really insulate themselves from it, but at least try to incorporate some of these changes into their own planning? Any advice to them?
Well, I'm not sure I understand totally the premise of your question, but what I can tell you is that people are getting spooked by all these very bad changes. And what that is driving is a massive increase in people wondering if they should leave Canada, and then a massive increase of people leaving Canada. Yeah. And I've written about that a lot too. And I would say for every 4 people that ask about it, 1 is actually pulling the trigger and leaving it. And so what the capital gains inclusion rate increase it was the final straw for a lot of my clients and a lot of people. I know a lot of other practitioners' clients that they said, Moody, just get me the hell out. Do it now. And even last week, I had 4 new files on very successful Canadians who want out.
Wow. I mean, they just said this and no more.
And you might think that that's not, or your listeners might not think that's a lot, but that is a lot.
Yeah.
4 successful Canadians in 1 week pulling the trigger, that's a lot.
Well, and we're not seeing 4 successful people from other countries necessarily showing up to replace them.
We're seeing a lot of international students, which don't pay tax yet.
It's not the same thing, really, but it's welcome to Canada, which is very good. But we deal with that too, right? Because we're in both Canada and the United States, so we see a lot of the movement, and there's a certain natural amount of movement as people are retiring, coming home, or their job takes them. But we've certainly seen an uptake of people asking the question. We've had a couple that I think they don't like maybe the way U.S. politics are going. They're like, how do I leave the United States? But that's a different dialogue. But certainly I think the mathematics for a lot of economically successful Canadians are kind of looking south of the border saying, look, if I can get there, that's a lot better. So could we talk? Because I know you do a lot of cross-border work.
Yeah.
For like on some of these comparatives, if I'm a physician or an entrepreneur or something in Canada, what does the U.S. tax, give us a little bit of a picture of what would U.S. taxation look like in terms of what are their marginal tax rates, what income thresholds do they kick in at? Like what's a good comparative here?
Yeah, I wrote an article about this in the beginning of January, just on that very topic. And it really is state sensitive, like where you're coming from in Canada and where you're going to in the States. I did a comparison of somebody moving from Ontario to Florida. Well, Ontario is one of the highest, it is the highest tax rate province in Canada, along with BC and some of the Atlantic provinces of Quebec.
And Florida being one of the cheapest, right?
Right, because there's no state tax. And so when you take a doctor, let's say he earns $1 million in Canada, forget about foreign currency adjustments because that just adds to it. But earns $1 million in the States, just off the top of my head, we're trying to recall the math in that article. Just between the 54% rate in Ontario and the high rate in Florida is 37%. That's a 17% delta. Now it's a lot more complicated than that because of comparisons of credits and available deductions and what have you. But just alone 17%, that is a significant number. Oh, and you know what? Just as we're talking here, I got an email come in about a client that wants to leave.
There you go. Just as it happens.
Just because it flashes across my screen.
Yeah.
So I am paying attention, Darren, but I saw
No, it's all good. But that's the thing. Like, that's how regular this is, right? But the thing is it's not just that it's a 17% difference. It's also in the dollar of income, right? So in Canada, we hit the top marginal tax rates at like $200,000-ish, depending on the province. But in the US, when do you hit the top tax brackets?
Well, it depends on the state, of course. But I always use, just as a rule of thumb, which is very conservative, because in most states it's higher, $500,000. Right. And Florida, off the top of my head, I think is higher than that off the top. I always have to double check these states because there's 50 of them and they all have.
Yeah, I agree. They're all a bit different. And California and New York are higher than Florida. But at the end of the day, there's generally an overall tax savings for the vast majority of states, right?
For sure.
And then they can do other things. Sorry, go ahead.
I'm working on a file right now where we're just crunching that math for this particular guy because he's got a lot of capital gains upon exit in Canada. Because, of course, there's a departure tax, deemed disposition of all your assets at fair market value, minus some exemptions. And we're trying to figure out with precision how much tax he's going to save, because this fellow is moving from British Columbia to Florida. So same math as Ontario. And I can tell you, we're only about halfway through, and the number's big. The number's very big.
Right.
And so now the usual thing I get is, especially when I write about this, is, oh, yeah, Kim, but what about estate tax, U.S. estate tax?
Yes.
And the short answer is,
Isn't it much higher there? The U.S. has this inheritance. Canada doesn't have an inheritance tax.
They have a deemed
disposition is a bit different. Yeah. So our taxes here actually be much higher than an American would experience.
Well, it depends on the net worth, right? Because as you know, if you're over the exemption amount in the U.S. of 13 million roughly right now, then you're going to pay U.S. estate tax upon every dollar in excess of that amount. Now, for married couples, it's double that. And so there's some significant planning that has to be done if you're moving, like a family of a couple $100 million of net worth into the United States, right? You got to be careful with that.
Sure.
The other issue I hear is healthcare. Oh, healthcare is very expensive.
It's free, and it's free here.
Yeah.
I think COVID put paid to a lot of that belief system, right? A lot of people are like, maybe it isn't what we thought it was.
Well, I still get a lot of email traffic on it and letters. And so, all I say is, it's interesting that a lot of my clients have been able to figure that out. Oh, and by the way, the quality of healthcare is a hell of a lot better.
Yeah.
And yes, the premiums are more expensive, but not as astronomical as the mythology does say. So,
think of how much health insurance you can buy with that 17% that you're not paying to Ontario, right? So,
exactly.
So I think from our perspective, when people are looking at this, my answer is like eyes wide open, get the right people that know what they're talking about to consult on your situation so that you can make a fully informed, proper decision on what to do and how to do it. I find when people just go on the internet and play the home game, it doesn't work out very well.
I agree.
That doesn't work so well. Now, I'm going to ask you, because you're writing, you shared with me an article that's going to go in the Financial Post in a couple of days. You kind of gave me an advanced look at it. And in there you mentioned, and maybe this also, you got to pay a quarter royalties to Mr. Mintz. But because I don't like people that whine but don't provide a solution. So I think you're also in that category where you want to present a solution. And one of the ideas that I'll ask you to talk about that might be a way that if you could run the tax policy for 20 minutes, this might be something you'd consider. So you guys mentioned that Estonia actually might be a source of inspiration for better tax policy. Could you take us through what the Estonians are doing?
Sure. So Estonia, it's been rather well known that they revamped their tax system back in the year 2000. So it's 24 years old already. But 24 years provides a good source of data to see how it's worked. And so Estonia only rather recently, with people like Jack Mintz, has gotten some rather good attention on what their system works. I first tripped across Estonia with some clients, well, one in particular, one large one that moved to Estonia for their manufacturing operations. And it goes something like this. You earn money in Estonia company, and as long as those funds are reinvested back in the business, then there's no corporate tax.
It's kind of like an RSP in a sense, right?
Yeah. But eventually, when those funds are distributed to the shareholders, then there's a corporate level of tax. Now, when you combine that, and Jack does a really good job in a 2022 paper that he wrote on this, And by the way, there's the Fraser Institute wrote about it earlier this month, and then Trevor Toombs, who's a University of Calgary economics professor, he wrote about it this month as well. And so it's getting a bit of traction.
Oh, that's interesting. Okay.
So I thought I'd add to the pile. So that's why I wrote about it in this post article. But what's interesting in Estonia is they have a 20, and 20 system. So when you eventually distribute those funds, you pay 20% tax. But they also combine that. There's a 20% value added tax, like our GST.
Okay. So you pay 20 on the 20.
Yep. Well, no, you don't pay 20 on the 20. It's just if you buy stuff.
Oh, okay.
It's like our GST. You're going to pay 20%.
I see.
So
okay.
it's like a consumption tax, right?
Got it.
But then there's also a flat tax on your personal income of 20%. No progressive rates. It's just flat 20. But there's an exemption for the amounts that have already been paid on this distributed profits tax. So if it comes out of the company, you're not paying another 20. And for low income people, there's a bunch of exemptions so that it's not very regressive. So Jack talks about it as 20-20-20, and it's a very powerful system. But just focusing on no corporate tax, what does that do? Well, it encourages investment and reinvestment and hiring and expanding. And when you look at the number of entrepreneurs that compared to Canada, and the Fraser Institute wrote about this about 2 weeks ago, the number of entrepreneurs per 1,000 people in 2023 is 49.4 off the top of my head, something like that. Whereas in Canada, 4.9.
Wow. So we're a tenth of that. Incredible.
Yes.
Wow.
Yes. And then there's a bunch of other amazing statistics, on GDP and GDP growth and what have you that I can't remember off the top of my head, but it's rather impressive. So does Canada need that kind of bold thinking as opposed to, let's go after a home equity tax, or, let's tax principal residences, or let's tax luxury cars and vehicles? Like, what a waste of time.
So it sounds like not only is this bad policy, but what I'm inferring from this is that there's a certain amount of envy tax, if you will, right? There's a little bit of class warfare, I think, that might be behind some of this. And I don't know if that actually lands well, right?
No, it doesn't. It just alienates and divides, right? As opposed to if you encourage and celebrate success. Well, how is that divisive?
Yeah.
That's if you're creating more jobs for Canadians and making people more successful, and reinvesting those in Canada, and then enticing talent to Canada. Wow. That's a great story.
These do sound like really good things. Well, it looks like you're not going to be wearing orange glasses at the next election run, whenever we have it. I'm going to guess that's, although you're in an orange room, so maybe we got to talk about your paint colors. This is you. Hey, it's all good. So this is actually really helpful. So as a Canadian dealing with some of these issues, do you think that all is lost, or is there hope that this might get better?
I think the only way this gets better is if we have government change, because this particular federal government is so ideologically entrenched that it's beyond. And I've always maintained hope. I mean, as much as I despise them when they took office right away, they're just not my political cup of tea, and I despise that version of politics.
That's
but
very entitled to that opinion, for sure.
Yeah, and it got worse and worse and worse and worse over years, and there's no way to turn this around on a dime. Right. So you need a government change in order to make these bold changes that are necessary for the benefit of all Canadians, not just, a particular voter base. And yes, I understand that that's politics, but we need that change.
Hang on. Let me challenge you that. I'll
Sure.
Because we keep seeing every once in a while these reports from the IMF saying, Canada's growth is going to lead the next 6 weeks or 2 years or whatever, or where our living standards are stuff. So this is a question, because this is some of the stuff that Canadians are being told. Should we question these or just eat them like applesauce?
Well, I think you know the answer. I think you need to take any particular think tank, whether they're ideologically aligned with you or not. Yeah. You need to take it with a grain of salt, because crystal balls are only as good as, I don't know, pick your analogy. They're not. Who would have predicted COVID? I certainly didn't.
No. To be honest, there's not a single analyst who predicted that stuff.
Right.
Right.
And so
my crystal ball didn't work. My magic 8-ball's out for repairs. So, all the things I use to forecast are not working either.
So I think when you have an outlier report like the IMF, you can either accept that, like the Liberal MPs last week, were crowing about, hey, our economic plan is working. It's like, let's go dig into this. So I went and took a look.
Okay.
Yeah, I don't understand it. Whereas I do understand some of the other concerns. Some of the big banks in Canada put out some very thoughtful reports. Some of the Fraser Institute put out, rang the alarm bells. Most mainstream economists that I know, the ones that are not just partisan economics or economists, which there's
hacks, I think you said. But anyway, yeah.
Yes. Most reasonable centrist economists are ringing the alarm bell. And so I think there is significant cause for concern. Just on one thing alone, for example, our rising debt and public debt charges.
Yeah.
Do you know how much that is now?
I do, but share with the audience how bad it's getting. It's astronomical.
This year is predicted to be 52 billion, I believe, off the top of my head.
Remember when we had deficits that were 20 billion and we thought that was a lot?
Yeah. And now our public debt charges are 52 billion. Do you know what we transfer to the provinces federally for healthcare?
Not that much.
I believe it's 55 billion off the top of my head.
So it's getting close, right? So we're spending.
Do you know how much? Do you know how much? Last one for you. Do you know how much we collect in net GST as a government?
No, I don't know this one actually.
It's about $50 billion.
Oh, so what we're paying on the debt. Well, this is really interesting because a few years ago when interest rates were 1%, I believe our economic policy was we could afford the payments. I think what that came down to, right? Which as a financial planner is really not what you want to do, just as a pro tip.
There's a famous clip during COVID with Trudeau being asked this very question. He says, "Oh, Glenn, you realize that we're at historic rates of interest or low interest rates, right, Glenn? You know that?"
Yeah.
And I'm thinking, oh my God.
Yeah, this was when we had the step of commons at the cottage because everything was there, no haircut, which also fascinated me because, again, I don't think you need to be a genius, but if interest rates were that low, many people went out and, reshaped their personal debt. They restructured, refinanced their mortgage to lock in those lower interest rates. Shocking that the government of Canada did not restructure our federal debt to lock in. I don't know why we didn't start issuing 100-year-long bonds at 2%, but what do I know? But I think there's a bit of urgency to getting our house in order from this perspective. If we look at the U.S. is going to go into an election in November, and I believe whether you want either party to win, whoever your fan is, both parties are fairly protectionist in how they want to do things, right? So I think this is whether it's a Democrat win or Republican win. And for a while there, it looked like it was a game of survivor. Whoever makes it to November is probably going to win. Now we've seen a bit of change to that. But do you think Canada should be expecting whoever gets in the White House a positive relationship, or is the U.S. going to really mind their own store and we might be in bigger trouble than we've been in before?
I share concerns on the latter. I think Canada really needs to concern itself with who's going to be in the president's chair. There's things about, I think both, before Biden stepped down and now it's Kamala Harris as the shoe-in from the looks of it. I think both human beings as leaders in air quotes are pathetic. I just
it's a
can't
struggle.
believe,
like this is the best you can do.
Yeah, and I was just going to say that you got 330 million people, and this is the best you can do. I don't get it. In terms of policy,
I think we should take the top two people from America's Got Talent and let them try it. I don't know. I think that's just my personal thought.
But of course, on the tax and economic side, I mean, I just, looking at the Democrat policies that continue to come out, a leaky border, high tax rates, a tax on the rich, blah, blah. It just goes on and on and on. And I'm certainly not aligned with that at all if I'm American.
Right.
Whereas I look at some of the other policies, tightening the border, encouraging more defense spending and, looking at better tax policies and et cetera. I'm more aligned with that, of course.
Sure.
But then all of a sudden there's other policies that I'm certainly not an expert in that comes out on, some platform like Trump came out and called Alberta oil dirty oil the other day. And you think about that as like, hold on a second, who's been telling you this?
Yeah.
And that, certainly in my home province, that had a lot of people's backs up. And for Canada, that should have the average Canadian's
That's a problem.
back up.
Yeah,
that's a real problem, right?
Agreed.
And so I think there's policy concerns and certainly concerns all the way around, no matter who sits in that chair. And I think Canada needs to get ready. And in my view, it means strong leadership.
Agreed.
And
agreed.
And unfortunately,
to go fight our case, right? To go fight our case with our best friend and our neighbor and our cousin.
And we don't have that right now. So I worry about Canada.
Yeah, tricky times ahead. Well, listen, my friend, thank you. It's been about 40 minutes. Thank you for your time today. I really appreciate the comments and the thought leadership you continue to provide in the estate planning and the tax community in Canada. So keep up the good work. Thank you for your time. Any parting thoughts as we go?
Next time, I'll wear a jacket that competes nicely with our friend Trevor Perry. But I'm on vacation today, so this is as good as it gets.
I think one of those paperboy caps might work. He likes the bowler hat. You got to pick something else for you. So I'll let you guys fight your sartorial battle. It's fun for me to watch from the sidelines. So good on you. Actually, maybe I should get both of you on one of these things and just
that'd be fun.
I'll throw something contentious up and watch you guys play jump ball for it. So
that'd be fun. Let's do that.
You agree on a lot of stuff, so I'm gonna have to really pick the thing that makes you both hungry for a fight. So, Anyway, I'll ask something about again, pinstripes or checks. Off you go. Discuss. I'll have to find something for you guys.
Yeah, it'd be fun.
To it. Okay, brilliant. Well, listen, thank you very much. Next time in Calgary, I'll come and visit. And for those of you listening and watching, thank you for your time and attention. We'll catch you in the next one. Thanks, Kim.
Thanks, Darren.
This has been Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic Podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic Podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd. and Raymond James USA Ltd. financial advisors may only transact businesses in provinces and/or states where they're registered.